Hello and welcome to today's webcast, Managing vPPA's Volatilities, Why 2024 Was So Bad and What to Expect from 2025. I'm Sarah Golden. I am VP of Climate Tech here at Trellis Group, and I am also Executive Director of Verge, and I'm excited to be moderating today's conversation. Before we jump in, I wanted to go over a couple of housekeeping notes. As you can see on the screen, this is what your system looks like, and you can move and resize the windows on your screen to customize your viewing experience. Feel free to make the slides bigger or the speakers bigger, whatever works for you. This session is being recorded, and we will share the link with all registrants later today. If you have any questions, please put them into that Ask a Question box down at the end. We will get to as many of those questions as we can in the second half of the webcast. Also, feel free to join the conversation in the group chat button down below. And finally, at the bottom, you will see a resources section, and that has additional materials that are available for download. We'd also love for you to join the conversation online, so feel free to share anything you're hearing today with the hashtag Trellis Webcasts. Now, let's talk about why we're here. When organizations sign a virtual power purchase agreement, a vPPA, it's making a bet on the future power prices. In 2024, that bet went sideways for a lot of companies. Volatility in energy markets, unexpected generation outcomes, and opaque forecasting practices left clean energy buyers scrambling to explain performance gaps to finance and leadership teams. So today, we will be exploring what happened to vPPA performance in 2024 and how buyers can adapt their forecasts and internal processes, as well as what to expect from energy markets in 2025. And we'll also talk about how data and transparency can help buyers regain confidence as well as control. To help with this conversation, I am delighted to be joined by Shahzad Wadawala, VP of Strategy at Verse, and Sam Cortrell, who is Director of Client Enablement at Verse. These two guys have worked with dozens of companies to help them understand and manage the complexity of vPPAs. And so I'm delighted to turn it over to them to hear what they have to say.
Thank you, Sarah. Starting first is, what is a vPPA? So first of all, that's a virtual power purchase agreement. That's ground zero for the rest of this discussion. I'm sure many of you have seen diagrams like this before. And just kind of going through the basic structure of a vPPA, you have a renewable energy generator, and that's the developer who signs a contract with the buyer or the organization or corporation in the bottom right. And the developer is the one who interfaces with the wholesale market. This is like the system operator, like the ERCOTs, the PJMs. And then the organization or the corporation also has their electric service through their retailer or their utility. And so they get electricity and pay a retail price. The main thing to take away from this slide is that the utility or retailer relationship with the organization is completely independent of the virtual power purchase agreement, which is a financial contract simply between the buyer and the renewable energy generator. And the most common structure for the financial settlement is a fixed price contract where the organization agrees to a fixed price for the renewable energy output in exchange for a floating price or a wholesale market price that gets passed through in terms of the financial settlement. There's a net settlement, and then on top of that, a key reason for doing this for the buyer is they get the environmental attribute credits or the renewable energy certificates as part of the contract. So again, the main takeaway here is the virtual power purchase agreement does not affect your underlying electricity contract with your utility or retailer. It's a side contract and it's purely financial. So that's setting up what a vPPA is. As we go forward, want to talk to where are you as in your company in your vPPA journey. So I want to just get a poll started here. And while you're able to review that and put in your selection or what's relevant for you, just want to highlight that SEBA just put out its latest report, and we continue to see massive growth in the amount of capacity that's being brought online through vPPAs. Over 20 gigawatts was signed in 2024, which is the most ever. The cumulative total has now exceeded 100 gigawatts from corporate PPAs. And also exciting was there were 20 first-time public announcements in 2024. So we continue to see a lot of momentum in this space as vPPAs continue to be a powerful instrument for corporates to meet their sustainability goals. All right, give it 10 more seconds. All right, great. So this is great. We've got a good number of entities that have not signed any PPAs and are just trying to learn more, versus also a good representation on the other side of at least one operational PPA. So great. This is going to be an exciting discussion as we go forward. Thank you for that. So first takeaway is that energy markets are volatile. And what we have on this chart is kind of a representative sampling of different settlement points across North America. So this isn't just one market. This is a composite of a number of points. But the key thing here is not to fixate on any particular point, but more just the range of outcomes that we can see. So the different lines represent the settled prices for different years. So 2020, the pandemic, very low prices. We saw a big rebound in 2022. And 2021, the February was driven by the Uri winter storm that had very high prices in ERCOT and some of the neighboring markets like SPP and MISO. But the main thing to highlight here, and we've got a dotted line for vPPAs around $40, managing expectations. That's not where we say the market is today, but just over the lifespan of PPAs, that's a number that has been a reasonable number for PPAs in the past, and just kind of highlighting that just in a span of a few years, we've danced around both well above in 2022, well below in 2020, and 2024 was one of the lower ranges, or definitely closer to 2020 versus 2022, which was one of the higher years. And so just recognizing that over a span of a few years, this can be a pretty uncertain market in terms of what you can expect from the revenue for a vPPA. And what does this mean? What is driven here is that there's natural gas prices are the biggest driver of electricity prices. And just kind of foundationally, why is that? Energy markets, if you imagine your Econ 101 charts of where supply and demand meet, there is a clearing price. And in fact, there's clearing prices every hour, even in real time. There's every 5 minutes in some markets. That intersection of supply and demand is what sets the prices that are then settled for any generator and any consumer or load in those markets at those times. And so from that perspective, why is natural gas so important is the marginal unit that will set where supply meets demand is often a natural gas generator. And so therefore, the more expensive natural gas is, the more it costs for those generators to offer power or bid their power. And so the clearing prices in those markets then consequently get higher. And so what we have in this chart is just tracking what the historical Henry Hub gas price is, and that's the most liquid and reference point natural gas location. So in 21 through 2023, the average price was above $4 per MMBTU, is the unit of measure of natural gas. To convert that to an electricity price, a combustion turbine unit usually uses around 10 or 11 units of natural gas to convert that to energy. 2024, $2, so very low in the grand scheme and historically for natural gas prices. And 2025, including January, February, and then forecasted prices through the end of the year are again back at above $4 per MMBTU. So mid low twos to $4, that's a doubling of the cost of generation for many of those marginal generators in these markets. So number one, natural gas prices. And so what drives natural gas? There's higher demand, which we'll talk about a little bit more, policy changes, and geopolitical uncertainty. We've all seen what happened to natural gas prices in Europe just a few years ago with everything that was happening there. And then kind of more tactically, any policy around LNG, liquefied natural gas, can also impact the prices of natural gas. So as we unpack this further, what does this mean for vPPA revenue? So just as a rough approximation. We took some representative power plants in different markets. So ERCOT being Texas, MISO, the mid-continent ISO is middle United States, and then PJM is Pennsylvania, Jersey, Maryland in the Northeast, and SPP, the Southwest Power Pool. And for representative plants, we could see a swing for 100 megawatt vPPA of many millions of dollars, 7 million for an ERCOT wind project, to ranging to the 3 million for an SPP solar, just on the course of 1 year from 2024 to 2025. Those are big dollars at stake. And what the takeaway here is that this uncertainty does exist, and it's something that you need to acknowledge and certainly keep your leadership apprised of as it's happening.
And just jumping in, Shahzad, if you don't mind going back, when we're talking about revenues, we're talking about that market, that floating component, that market revenue that the actual generation unit is selling into the grid and receiving in revenue. So, we don't know what your PPA price is, of course, but we're talking about that floating component in that fixed for floating swap, looking a heck of a lot better in 2025.
Thanks, Sam. And so what does that mean? Another way to look at this is, what does that mean per megawatt hour of production, or the implied REC, which you can benchmark to unbundled REC prices? This is a big swing on what you're spending, and this is a reduction in spend. So with more revenue, that means the net spend has reduced. So you can see, $20 to $30 per megawatt hour benefit on your net spend per megawatt hour. So in many cases in 2025, you'll see a lot of PPAs that were maybe a big net spend in 2024 can become like a savings in 2025 with these improvements just based on natural gas and market futures. So we mentioned demand growth earlier. So kind of the big topic is data centers and AI and how much growth there is. And we can see that there's a lot of growth. It's in the news. No surprises here. Data centers are one of the biggest engines for growth in demand. WRI just put out a report on that as well, on how data centers represent over 40% of demand growth in North America. And on the right, we see that while there are power efficiency gains and continued investment in how to make data centers more efficient, there's still the net impact that there's going to be more demand and more energy consumption across the globe.
And these charts are wild to me. I mean, look at that. The data centers more than countries. That's pretty crazy. And then thinking about just historically, demand in the developed world has been flat for like 2 decades. Now all of a sudden we're seeing demand growth in these developed markets. It's quite a stark change from what the last 2 decades has been in power markets. And it's not the only driver either. I mean, there's industrial electrification, moving a lot of that scope 1 to scope 2. There's been a real impact in ERCOT from the migration of Bitcoin mining into West Texas, electrification of transportation. So obviously at data centers, these charts say it all. It's a massive variable here in that demand growth, but there are other factors that are contributing to that demand growth as well.
Yeah, I'm glad you said that, Sam. I remember when I used to work with municipal utilities, and there was a time where Bitcoin farms were like the big saver of like, hey, we need to support all our transmission infrastructure investments. And with rooftop solar, the demand was decreasing, not increasing. So Bitcoin farms were very popular. Hey, we want more of these in our location, our jurisdiction, so we can support investments in our grid. And even with the early data centers, and now it's completely switched, where it's hard to keep up for a lot of these utilities and for infrastructure and interconnection. So definitely there was a period of flat load for a long time, and now all of a sudden, are we ready for all of this growth? So one other concept I want to definitely highlight here is renewable integration and cannibalization. So we talked about just natural or power prices in general, but there's also something to consider with vPPAs, which is not all hours are created equal. And so what we're showing here is there is a cannibalization concept in the value of virtual power purchase agreements, and particularly on the revenue side that Sam alluded to earlier. We saw this, in California, there was a lot of build out of solar. And at the beginning of that solar build out, there was a lot of expectations that solar was going to be very valuable because traditionally California was a summer, high prices in the summer. But over time, there was a build out, and everyone, with rooftop solar and the build out of solar, just generally for the RPS standards, the prices in the middle of the day collapsed. And so there was a cannibalization effect. And so what I want to show on this next chart here is California had a lot of build out, but Texas is following a similar trajectory, just with a 5-year lag. And so really want to take away from here is what we're seeing in terms of revenue from power purchase agreements today are not necessarily the best predictor of what we're going to see a few years from now as the renewables continue to come onto the grids. And there is a very real effect of cannibalization amongst all of the buyers who are buying the same technology in the same grids. And with that, I'm going to hand it off to Sam to talk a little bit more about.
First of all, I felt like Hannibal was staring right through me there. Interesting slide there, Shehzad. Thank you. So yeah, that's a great table setting for the market conditions, the volatility, the changing in demand, the changing in supply. I think we've all probably heard of the duck curve. Is it going to exist, or rather, when is it going to exist in ERCOT and other markets for that matter? So when you're thinking about your vPPA, at first glance, it seems quite simple, right? There's a market revenue component. The price of power times the quantity generated equals revenue. And then, what's most important for probably all of you on the call here is, what does that mean for me in terms of my net spend or revenue? And what that's simply just saying, okay, well, I've got a PPA at a fixed price. We're going to generate a certain quantity. Usually we have an as generated contract. And what I do is I'm just going to take that fixed price and subtract the market revenues, and that's going to be my net settlement. And yeah, it is that simple, but it's actually a lot more complex than that when we break down those different components. So few variables, but a lot of complexity within each one of them. So when we're thinking about these layers of complexity, Shehzad did a great job laying out that market volatility. We talked about the hourly price fluctuations and that not all hours are created equal. The cannibalization effect and congestion on the grid, how curtailment's going to impact those valuable hours. And then of course, the generation uncertainty. So, the big question here is, how do we accurately get a P and a Q so that we can really focus on what that are and understand what the net spend or the impact to my organization is. So, what I love this one because, there's just, we're looking at the same picture here, right? That's Link. That's Nintendo's Link. But on the left, you're looking at an early version, a pixelated version, if you will. And on the right, we're shifting more towards, a high definition detail, realism, if you will, when we're thinking about something as simple as, just the evolution of a video game character. And when we're thinking about this video game, I challenge you to think about, how you're getting into data granularity. And granularity is important, but it's that quality as well. So, data granularity and frequency, but also the quality of said data. So, a P50, 8760, 8,760 hours in a year. We're thinking about this common industry standard. It's a single expected generation profile. It's based on long-term averages, typical weather year, if you will. We're thinking on the left here also about a fundamental forecast. Really important, but also something that's meant or designed to be looking out, decades into the future. This is not something that's updated on a very regular cadence. I guess in my experience, typically twice a year updates in these fundamental forecasts. They paint also a relatively smooth picture when we're thinking about those future expectations, because its job isn't to predict the weather, in 2035. It is meant to be more of that smooth curve. But that's just not how the world operates. So, we're thinking about like the real world and energy markets, and Shahzad just went through this. It's, there are changes every single day. They're influenced by weather, by demand spikes, congestion, different input costs like natural gas. And again, Shahzad just did a great job of showing us all of that. So, this is why a really refined forecasting approach is just integral in understanding that P times Q equals R. So, when we're thinking about these refined forecasts, we want updated market prices as frequently as possible. We want real-time weather modeling. We want those models to learn from historic performance, and therefore give us a more reliable picture of what that vPPA revenue side can look like. So, if you think about it, if your forecasting model isn't adjusting to these real world changes, like how can you be confident in the financial estimates that you're making off of them? So I want to dive into that a little bit more here in increased granularity, if you will, to play off of my link slide. So generation is variable. Like we're talking about intermittent resources here. When the wind is blowing, when the sun is shining. So we're looking when we think about even just a project. So this is an ERCOT West wind project sized at 100 megawatts. We're looking at in the purple that P50 estimate, and then a range using that a P10 and a P90. So P10, we're looking at significantly higher conditions. We're thinking there's a lot of wind, and I don't know about you, but the weather here has been pretty variable lately. I'm sitting in Colorado. I went mountain biking earlier this week after work, and I skied last weekend. There's just a ton of variability. And then you're also thinking about a P90 where there can be much lower wind speeds. There may be curtailment, some unexpected factors as well, potentially mechanical or planned maintenance, et cetera. So that variability doesn't, as Shahzad mentioned, just impact the total revenue, but also it affects the different hourly price settlements. So your project is generating more when prices are less, that's going to change the expectations on revenue. So I'm going to walk you through a little math here. We're looking at these bars and some pretty wide variation here. So just diving into a month, if we're thinking maybe one with a little wider variance, so I can make my point. You're looking at kind of a P90 around 26, 27,000, a P10 around 40,000 megawatt hours in a single month. That's a delta of 130,000 megawatt hours. Now, if we're perfect on our price estimate, and we have the expectation that we're probably going to net settle at about $10 out of pocket per megawatt hour in a given month, maybe in this indicative scenario, you're looking at a massive variation in spend. So we're looking at potentially over the course of the year, multiply that by 12, over $1.5 million based on the variation in generation alone. But as we were thinking about that equation where we started, P times Q, it's actually the P that is even more variable. So what we're looking at here is the ERCOT North future expectations over time for the price of August of 2025. So I'm going to say that again. We're taking the different days in which the futures were published and looking at them over time for the exact same month, which is in the future, August of 2025. And what we're seeing here is over this 6-month period, the expectations for how August of 2025 pricing might look around the clock has increased by almost 100%. So that variation is even greater than the Q part of the equation that we were just talking about. So these changes over time are really important to monitor, because if I'm updating my forecast every 6 months, I might be budgeting, thinking the ATC is going to be, and not even getting into capture rates and whatnot here, but thinking that the market price might be around that $78, and and again, not all hours created equal, but in reality, we're getting closer and closer to this $153 ATC in August, at least as expectations are today. So, instead of thinking, and I'm not going to walk you through the math here. I think this one speaks for itself. But if we're thinking about this real-time changes in the market, we need to adjust dynamically as the market is also adjusting. So doing that once or twice a year just isn't going to give you the most accurate picture of your PPA revenues. So what does that mean? There are, we can't just use our gut here and look into a crystal ball and try to project the revenue. We need to take a dynamic approach to understanding these market shifts. And that's something that we're really excited about here at First. So when we're thinking about these movements, it is of course about the budgeting, and we've talked about needing that forecast to understand the costs or the potential costs of my vPPA portfolio and how that impacts my internal communication with stakeholders, from finance to leadership, and what that means for me as someone sitting in a seat trying to project those numbers and clearly communicate with a degree of certainty what our organization might expect. But there's more to it as well. So with Verse we're thinking about the invoice validation as well. So how can I quickly verify that my invoice is correct, and that when I'm asking finance to write those checks or treasury, I'm doing so with the accuracy of that P and the Q. So making sure that the right numbers are coming in, and you might be surprised how often a row is off in the output from a developer. We're thinking about accruals and as well. So yes, understanding or seeing a picture of what we might expect is important, but also thinking about revenues month to date, quarter to date, and how they're moving compared to what our expectations were going into that month, going into that quarter, going into that year. So not just reacting to invoices, but also having a real-time understanding of how, as the wind is blowing and the turbines are spinning, how is that comparing to what our expectations were, and what does that mean from my expectations before I get the invoice. And then of course analytics and procurement strategy are a huge piece. So understanding the different dynamics of your specific portfolio and thinking about okay, what are the root causes of this past performance? How can I use them to make better decisions going forward? Are there potential financial products that I can overlay to mitigate that volatility, to lock in certain financial outcomes? So the right data-driven approach here helps you move beyond a reactive approach to your vPPA, and gets you into that proactive strategy-driven mindset. And with that, we're gonna throw another poll at you. Hopefully, you don't have any obstacles at your organization, but I think the reality is in today's market, where we've shifted from a buyer's market really to a seller's market, there are obstacles. And what I think we had a great distribution in our first poll of different stages in sustainability journeys for this audience. And what I want to get out of this poll is, okay, if you are facing some uphill battles in getting, or obstacles in signing vPPAs, what are they? And for this poll, please feel free to select more than one if you're feeling that there are additional challenges more than just a single point here. I'm going to give everyone a second to respond. Take a sip of my water.
Yeah, I think, Sam, you mentioned it's shifted a lot, this environment, where the first PPAs were a little easier, a bit of a sell, from just that they were showing that you would save money and become more green. And it was definitely a buyer's market when that whole thing started. And now the conversation internally is a lot different. Many evaluations lead to like expected net spend, and definitely some markets more than others. So it has been an interesting evolution on how to even message that internally, and whether or not and at what speed organizations are going to honor their sustainability commitments.
Yeah, definitely. And we have an awesome audience here, really high participation rate. Thank you, everyone. I'm going to jump to the results now. Cost uncertainty. I swear I didn't plant that. No, these are real polls. Yeah, I mean, look, we recognize there are a lot of challenges, but I think that it really speaks to, hopefully, our presentation spoke to you, 79.2% of the audience who are struggling with that uncertainty. Really interesting poll. Thank you, everyone. Shehzad, you had a couple of final thoughts before we jump into a bit of a discussion here.
Yeah, so having been on the buy side in a number of different environments, both like within the organization and in guiding, one of the main things is there's trust is fragile. When you make that decision, and for a lot of organizations, the first PPA is the biggest one to get internal alignment, and the performance of that PPA is really important to the credibility of the program. And so just highlighting something that Sam said earlier, just being able to communicate regularly and effectively with your leadership on what to expect from a PPA, what are the level of uncertainty. The poll really highlighted that uncertainty is big, and being able to manage and communicate around that uncertainty is both important for credibility of the program, but also just awareness of what is involved here. And then related to that uncertainty, this is kind of the human psychological element. When things are going well, leadership is like, oh, well, that's supposed to happen. And then when they're not, it's more acute, and usually where there's more deep dives and explanation required. And I would say here, being able to both highlight the wins and the losses and being able to communicate effectively here is probably the biggest tool to manage the feeling of the oh cruel world that the leadership might infringe on the organization if there is a low revenue year, for example. Yeah, and Sarah, I think I'm going to turn it to you.
Thank you, Sam and Shehzad. That was incredibly interesting to see all these different things that have been happening with vPPA prices. I have a question to just understand how widespread this volatility was felt. I've definitely heard anecdotally from different organizations that their vPPAs didn't perform the way that they thought they were going to, and different challenges within the market. Do you have an idea of like what portion of vPPAs didn't perform in the way that was anticipated, or about what kind of losses this felt like for different organizations that had signed these?
Yeah, great question, Sarah. So in the opening area, there was the around the clock prices for the different markets. So there's a few things. One, natural gas prices are a driver across markets. So we saw low prices across markets in 2024. I'd say the market that people were the most surprised by was ERCOT in particular, because ERCOT has a lot of spiky price events during the summer, and it was a more muted summer. So we saw that 2023 had very high prices in the summer in ERCOT, and so a lot of expectations were high that the revenues were going to be high there again. And then 2024, it did not materialize in the same way. So I'd say going to that diagram or that little cartoon with the loss aversion, a lot of this is expectations management. And so from that perspective, we have had customers talk to us about how 2023 was what they used to communicate to their leadership, and then 2024 just didn't pan out that way, and then having to backtrack and explain what was happening. And it's even more challenging when it's the first year of operation. So highlighted earlier, 2024, there were 20 new public announcements for first-time PPAs, which presumably aren't online yet. They'll be coming online in 2026. And just kind of highlighting in that journey, that first year of performance gets the most scrutiny. And so anyone who had 2024 as their first year was feeling it. But the good news is 2025 is looking better. So that's something that you can also take to management, as expectations are much better for PPAs in 2025 than they were in 2024.
Yeah, Sam, that's a great point, Shazad. It's, these are typically 12 to 15-year agreements. So, there are going to be bad months. There are going to be bad years. Hopefully, when you're going through the negotiation process and doing your financial analysis, you are thinking about the whole tenure of the contract, and the hopefully we'll see through those ups and downs performances around what you expected and what you've communicated. I think where we ran into a lot of well, at least our clients ran into a lot of difficulties last year was communicating with leadership why the expectations were so off. So your question was specifically around, maybe numbers and the impact felt. And unfortunately, can't share any proprietary information that, a lot of these deals are private between, the buyer and the seller and, their advisors or tech partners. But last year overall across all markets, expectations were higher than the results. And, depending on where your PPA strike price was, everyone was feeling it, but some definitely felt it more than others.
Yeah, like all of life, it's all about that expectation setting. We are going to be getting to audience questions too, so please keep those coming. I'm already seeing those roll in, and so please keep on asking questions in that Q&A box. Another question I have is, for years when I've talked to organizations about vPPAs on like a very high, just narrative level, the idea of it being a financial hedge, where like if energy prices are going up, then you're able to make more money off of your vPPA. And if the energy prices are low, then you get cheap energy. And what you're describing is a much more complex picture than that. And I'm just wondering, where does that logic break down for organizations?
Yeah, great question. Oh, yeah, I'll start on this one, Sam, because this one's most near and dear. So one thing, I will just say, we've been talking about bad years, but really low prices also can be a very good thing depending on how you're situated. If you're buying energy and you're a consumer, which all of us are, there's also the benefit of lower energy prices. So getting into that hedging comment, one thing that's really important is to have a holistic picture of your energy portfolio. We're all exposed to energy markets, whether through our utilities or retailers, and it will show up in our electric rates eventually as well. So from that perspective, PPAs or vPPAs are a directional hedge against what is the most common driver of our utility rates, which is that natural gas price that we mentioned earlier. And so from that perspective, PPAs can protect against rate increases and, any market-based rates that you're facing through a retailer, like in markets like ERCOT and PJM, for example. So from that perspective, low prices aren't necessarily bad, especially if you benefit from them on the lower cost for your consumption. But they may feel bad when you're showing a renewable program and they're separated from that conversation about what's going on in my consumption. And it's like, why are we spending so much money on this PPA? Well, it's like, well, we're saving money over here. And if you don't have those pieces together, it's a much muddier conversation when market prices are low.
Got it. We have a question in the chat, and like what you're describing is that doing something that your company may not usually do, that is complicated, that is requiring a lot of legal complexities, and then also may underperform, and then you need to explain it. So what are the benefits of doing a vPPA instead of just doing, say, a REC?
Yeah, I'll jump in here. Well, I think first and foremost is what the industry calls additionality. I like to think of it as the impact. the ability for your organization to publicly, say, without our action, this new build project would not exist. If you think about the capital stack of these projects, before we talk about tax equity or sponsors, or before you're putting many times the shovel in the ground, in most cases actually, there needs to be some sort of a financial certainty for revenues. If you're going to approach a bank, if you're going to approach an investor, they want to see that you've got a project that's good. And a lot of that is pinned on the fixed revenue over a long period of time that a corporation entering into a power purchase agreement is promising. That allows the developer to go to tax equity, to go to sponsors, to get these projects built. So it's really that impact story. And that's one way of looking at it. The other is there's a ton of volatility in the in the rec market as well. So if you're buying spot recs, that's fluctuating on a daily basis as well. So entering into a long-term agreement where you can make reasonable financial assumptions and understand over, again, riding the ups and downs, but over the long term, what the expected cost to lock in 12 to 15 years worth of recs, and to do so at a large scale for your organization, that can be really important in meeting your goals and really meeting the expectations of your investors and your stakeholders.
Yeah, and I love that point about also driving impact, that we are needing more renewable energy on the grid overall. Sam,
especially with that demand picture that Shehzad painted earlier, where there's going to be net new demand for electricity. And I don't know about you, but I want it to be clean.
Likewise, yeah. It's almost hard for me to comprehend what that graph is representing with that hockey stick in demand after all these years of relatively flat demand. Sam, you showed that graphic that was showing that often when these assets are generating energy, it may be at a price when the market is buying it at a lower point. And one person in the chat asked about the role of energy storage and potentially shifting when you're selling your energy to a more valuable time. What they asked is, with capture rates declining, how do you see energy storage playing a role, either as part of new PPAs or as a retrofit to existing PPA? Is this something you've thought about at all, or is this something that's happening?
Yeah,
I'm going to start with this one.
That's right.
Yeah, so definitely, storage is essential to any renewable future. Obviously, we continue to depend on natural gas plants to fill in periods when the solar is not going or the wind is down. California is the classic example with their duck curve and the evening ramp. Traditionally relied very heavily on natural gas peaker plants, and increasingly with the storage mandates in California, storage is playing a big role. And I would say contracting in California, no one will contract with a solar plant without storage being part of it. And we're seeing more of that in ERCOT as well, that solar and storage are almost always offered together, recognizing that there is this risk that the revenues during just the solar hours may be vulnerable to the cannibalization. And so therefore storage is coming in more. There's different structures there. But definitely storage is a big part of the future here in order for us to keep up with all that demand without necessarily building a lot more fossil fuel plants to keep up with it.
Yeah, I had to flip back to, I think, what is my favorite slide here, especially the glass Chianti on the side. But yeah, just to summarize what Shehzad said, look, we're generating whenever we can with renewables, but it doesn't always correspond to when the electrons are needed. So the ability to flatten some of that volatility, the evening ramp you're talking about, the trough of the duck curve with energy storage assets is huge. And I think the question is, can corporations benefit from that? And the answer is yes. There are many corporations who have similar structures to vPPAs in place with energy storage assets, not even just co-located. Co-location it was, is incredibly important, and it's pre-IRA, something that the only way that storage could benefit from the investment tax credit. But now that standalone storage can independently retire, or I guess redeem investment tax credits, we're seeing cost declines. We were already seeing cost declines from the technology standpoint, but this additional incentive is adding to the queue of storage, which is great. And corporations, to get back to the point, sorry, I divested there a little bit, but diverged. We're absolutely seeing companies who are soliciting offers from developers for co-located and standalone storage, and they are thinking about it in two ways. One is, okay, I have some volatility in my PPA. If I have storage in the same market, what kind of relationship can that play? Another is, well, I have some pretty advanced targets, and shape is important for me. So maybe I'm not trying to maximize the revenues. I'm trying to obviously do the best I can with revenue, but meet certain renewable shape profiles that are important to my organization. And then, of course, there is the potential for revenue upside as well. So great question. We're seeing a lot more of it as costs have declined, as more standalone storage is hitting the market, as the prevalence of cannibalization is felt more and more by some assets or some ISOs. So yes, we're really excited about the role of storage and how corporations can be a part of that story.
You had mentioned the role of the ITC, the investment tax credit for solar. And I know these tax credits have played a tremendous role in the rise of vPPAs. And we're also at a moment with some uncertainty of the future of what kind of financing will be available, especially through IRA. And I'm curious if you're seeing organizations thinking about this in a new way. Is this uncertainty about what kind of federal support there will be for deployments impacting how people are thinking about their vPPAs?
Yeah, I'll jump in here, Sarah. And definitely we're seeing, when we're talking about PPAs, there's, in the commercial language, the power purchase agreements themselves, there's regulatory risk, and that's captured in the PPAs of what do we do if the assumptions on the ITCs change, if the change of law risk. These are ground zero for a lot of the negotiations that we're seeing. So it's definitely top of mind, both from negotiating the new PPAs and from on the developer side, as they're willing to price these products to the buyers. Sam, I'd love to hear your thoughts.
I would just add that tax credits in energy aren't new. They've been around for decades. So and traditionally have benefited from a lot of bipartisan support. You're seeing a lot of benefit in different states. So red states, blue states. I think something like 80% of the investment in renewables have benefited red states. So don't quote me on the exact figure there. It's somewhere in that ballpark. I didn't pull it up in front of me, but what we're seeing is a lot of the investment benefiting very diverse constituents, and therefore seeing a lot of bipartisan support. The tax credits have had to be renewed by Congress over and over, and we're actually in a place where, from a legislative perspective, we're seeing more certainty in the longevity of the tax credits, without some sort of major repeal requiring a supermajority. But the actual currently legislated timeline is longer than we've ever seen for tax credits. So we're looking at that, and obviously don't have the crystal ball that we talked about previously, but are seeing a lot of bipartisan support for the continuation of renewable tax credits.
You mentioned last year was a tough year for the performance of vPPAs. And so I'd imagine that there's different energy procurement managers that are having uncomfortable conversations with leadership. And I'm curious if you have advice of the best way to be explaining underperformance to leadership without losing that trust.
Sam, do you want to go first, or should I on this one?
Yeah, I mean, I would just say, you know, proactivity over reactivity is the biggest thing. So, you know, do you have timely answers to critical questions? You know, if the market prices weren't what you expected, if the generation weren't what you expected, you know, how are you getting ahead of that, rather than getting an invoice, having sticker shock, you know, having it vastly deviate from, you know, what you told your treasury or finance team to expect, what you told your leadership team to expect. I would just say that the biggest thing you can do is keep that dynamic view of the market, and update expectations as things are moving, not after they've already moved and you know the invoice is in your inbox. You know, and I think that's where, you know, daily updates, model generation, daily updates on pricing, model generation, you know, real-time accruals, all of that just gives, you know, these energy managers the data that they need to clearly communicate, what's happening and expectations with the different stakeholders in their organization.
Yeah, and I'd add also here that there's kind of two parts. Like one is what's going on with the market at large. So we talked about natural gas price movements. If the whole market is down, that's a lot safer position to be than my specific project is not doing well. And so that's where the deeper look happens, is maybe there's individual congestion at your project that's really harming the revenues. Maybe there's mechanical availability challenges and you need to have a conversation with the developer about what's going on. Why aren't you generating when everyone else who's got a wind farm is generating and the prices are some of the best of the year? What's going on? Because it's hurting my program. So from that standpoint, it's having the ability to have data-driven conversations with your leadership on what's going on with the market, but also knowing what's going on with your individual project and being able to have a dialogue with your developers or your counterparties as well. Because in those situations, leadership wants to know you're doing everything in your power. And that means that you have data and tools available to you, and you're acting on that to make better decisions for the program going forward.
Another question from the chat is, when running downside scenarios for your vPPA revenues, what are the key assumptions you would sensitize and by how much?
So we started with natural gas is kind of the starting point, low natural gas. So we already showed in $2 was a low year for 2024. And then we've seen much higher gas prices. You know, there have been times like Katrina where prices got up to $14 per MMBTU. There was a period during 2022 when natural gas prices touched near $9 or $10 per MMBTU here. So natural gas is usually a big starting point. But then going back to my comment on the last thing, there's individual project performance, the capture rate for your specific plant. If you're going to have congestion or you know, weather is another one in terms of how much volume or quantity you can expect. So natural gas capture rates. So it's so that P part, and then the Q is the next part. So weather in terms of volumes are kind of where I'd stack order in terms of the downside scenarios.
We are just about running to the end of the webcast. I'd love to ask you a final parting question. As we saw in the first poll, a lot of people are yet to sign their first vPPAs, and they're joining this webcast. So I think that they're likely thinking about it and are in the works of it. And so what advice would you offer for companies that are considering their first vPPA today?
Sam, you want to start?
Yeah, I guess, you know, if you're thinking about your first vPPA, I would say that stakeholder alignment is really, really important. You know, what's driving our company to do this? You know, what does that mean? What does this mean for our organization? You know, is it a company that has a product that they can then say is, you know, this specific product is green? Is it, you know, our major investors are really focused on our scope 2, you know, understanding those drivers internally, and then aligning the different stakeholder groups. So, you know, making sure that, you know, your leadership understands, you know, that it is a long-term position, that there is volatility, you know, intraday, intra month, intra-quarter, intra-year, intra-contract, right? I think aligning those expectations, and then you're just really having the best data available to explain, not just what has happened to the market, but how market expectations are shifting, and being able to, show visually, conceptually, to your leadership, what these contracts are all about, and then tying that back into why it's important to your organization would be my advice for seeking first-time approvals for vPPAs. Be interested if you have additional thoughts, Shahzad.
Yeah, I definitely think that just being honest and transparent, and especially with the data insights, there are a lot of risks with doing a vPPA. So it's important that we don't hide those risks when getting alignment. So I know that there's a temptation to advance the program and to get the ribbon cutting across the line. But if it's on the foundation of like not communicating what uncertainties that exist, and getting clear buy-in of we're accepting these risks, knowing that there are also the benefits of the impact we're making on our communities, towards our sustainability initiatives, impact. If that's not what's driving it, and it's driven by like, we think we're going to make money, and the whole foundation of the clean energy program is at risk if that doesn't come true, that's just not a very comfortable space to be in.
Well, that ties right back to what you were saying earlier, Shahzad, about a holistic approach. Like, is there a hedge value for the vPPA? The answer might be no, but it is something you should look into. If your load doesn't correspond with markets where vPPAs are an option, maybe there's less correlation there. But also, if we understand our load, if we understand the potential impact of on the supply side with a vPPA, also thinking about holistically, are there other financial products that can help me limit volatility, whether it's contract structure in your vPPA or independent financial products. So I think not looking at the vPPA in a silo, thinking about the holistic energy profile of your company, but then also, of course, tying it into why are we looking at this, and what are the drivers for our organization.
Well, thank you both for bringing these insights. This has been a really fascinating conversation, especially at this time. So unfortunately, that's all the time we have today. But huge thanks to Shahzad and Sam for sharing their insights, and also thank you to the behind the scenes team for keeping things running smoothly. We have some resources if you'd like to dive into this further. You can find on that resources download button at the bottom of your screen this blog on vPPAs and penguins, and then a blog on vPPA risks, as well as a 2-minute explainer video on vPPAs. If you would like to watch any more Trellis webcasts, you can visit trellis.net/webcasts. And on behalf of Verse and Trellis Group and all of us here, thank you so much for joining. I'm Sarah Golden, and until next time, take care.